Okay, so it's kind of flattened out on the Nifty Bank. The Sensex is up 0.5%. Small cap index is up about 0.5, 0.6 odd percent as well. 100 points on the Nifty. The Sensex is up around 400 points as well. You know that at the margin, was there some expectation? It was a binary event. Who knows, right? But at the margin, was there some disappointment with regards to, Korea not getting bumped up and then opening up space for weight increase as far as India is concerned for global funds? Perhaps, yes. But not really the big driver at all. You got bulk of it, at least with the Nifty 50 heat map opening up in the green. Ultratech, Titan, NTPC, RIL, Power Grid are top of the list. And at the bottom, you got about 4 names which are starting in the red. It's a good start, about 1/3% higher, 25,135. Surbhi.
Okay, 90 points up for the Nifty, though the Bank Nifty is flashing a little bit of red, you'd have to say. Not showing too much of enthusiasm immediately. Let's talk about the Nifty gainers then. On the gaining side, Titan, we just heard the view from Macquarie come in. That's working well for the stock, almost 2% up there. Trent is also up. There's some buying in IT names. Let's see if it last day, unlike yesterday. Wipro is slightly higher, 1% higher. HCL Tech is about 1% higher. Reliance is a meaningful contributor. Gain of almost 0.7% on Reliance as well. Lever is up about 0.5%. So that's what's bringing up the upside for the Nifty. The downside, financials are a problem. ICICI Bank, Kotak, SBI Life, Axis, HDFC Life. It's banks and NBFCs not feeling too great this Wednesday morning. Bank Nifty is flashing a little bit of red. Before I hand it over to Nigel, I just want to complete that point on IndiaMart. The reason that stock is up 5% is because a Nuvama note has come out. Nuvama has upgraded it to a buy. It's increased the earnings estimates by 9-10% because it feels that revenue growth will now start moving higher with what the management has been doing. So that's an interesting stock beyond the Nifty, up almost 6% now. Nigel.
Well, that's right. That's a big upgrade actually coming in from Nuvama because they have upgraded the stock to buy from reduce. Remember earlier they downgraded to hold, then they went to reduce. And now, in fact, the target price from 2,100 to 3,800. So big, revision out there. And also the multiple they're giving is 35 times. Earlier they were giving it 22 times. So that's about IndiaMart. What else? MediAssist. That one's moving with some good momentum this morning. So that, in fact, is up closer around 3%. Big shade of green out there on MediAssist, up 4.5% now. Mukant, another one that we don't talk to very often, stainless steel player. The hope was that, in fact, they will see a bit of a turnaround, which hasn't been forthcoming actually in the last few years. But in the last 2 trading sessions, massive volume-based buying is what we've seen out there, delivery-based buying. And that stock, in fact, has moved up in style. So good going on that one. A few other names, not too much of volumes out here. So the Nifty is up close to 120 points. That's pretty good going. But as we mentioned earlier, it appears the Nifty Bank a bit of an underperformer today, and that's up of only around 30 points. But the number of stocks advancing to the number of stocks declining, 4:1. You like that look on the screen?
Nigel, there's a stock, Enviro Engineers Infra, right?
Yeah.
Which is EIEL, Enviro Infra Engineers Limited. Okay, I think it's down. It's down about about 1% or so.
Was the big mover yesterday?
Was the big mover yesterday? Absolutely. All right. I think what we'll do is we'll look at more stocks as we go along. But our market conversation is what comes up next. So let me bring in Sandeep Bhatia, who's with us. Sandeep, always a pleasure having you with us here. Good morning. Prashant here. Sandeep, of course, is Managing Director, Head of India Equity at Macquarie. Sandeep, a lot of volatility, but the market has been very, very steady. And I guess we kind of, away from geopolitics, start to focus back on more local stuff and more trade-related stuff and all the supply which is coming into the market. How are we placed? I mean, the mood is positive, but there is reluctance to chase things higher in a big way. Would you agree?
Yes, definitely, I would agree. So pleasure to be on the channel again. Good morning to your viewers and to all of you in the studio. What do we say? I don't think geopolitics goes away permanently. In fact, I would think that we are in the age of geopolitics for the next till at least the end of this decade, for the next 5 years. And in the interim, I think India has actually started on the margin seeing improvement in consumption. I was just reading the May data on credit card spends. That's up some 15%. We all know that the monsoon progress has been good. The monsoon has covered almost all of India except parts of Rajasthan and Haryana, Delhi. So hopefully we are in for a good spell of monsoon and therefore agricultural growth, and therefore rural consumption. So all told, India will be in a good zone in the second half onwards. I think I was just talking to senior fund managers yesterday. The RBI cutting rates, the tax cuts which happened in Feb in the union budget, all of it point to significant impetus given to the economy. So I would think we could be pleasantly surprised in the second half. Valuations remain very demanding. There's a lot of supply of paper. On the flip side, that's where I think the market, as you just said, seems to be in a bit of a balance. A lot of good things happening, but also a lot of supply.
Hi, Sandeep. Is that supply becoming a concern? I mean, just the extent of it, and it's coming from everywhere, IPOs, blocks, etc. And local mutual funds, they're not getting in the kind of equity flows they were getting, say, back in December or January. Is supply a concern?
Supply would be concerned if we see some reversals happening in, further reversals happening in flows into the domestic mutual funds. Supply would be a concern if there's some bad news on earnings. I don't expect that, but yes, if that happens, then definitely supply is a concern. I don't think I would be too concerned about even a market correction of up to 10%. It's something which is required. It's something which is would actually present an opportunity. We had great supply and a lot of issuances coming in last year. It was one of the best years for investment bankers. I think this was seen to be a weak year, but actually it started on a much stronger note than anyone anticipated in terms of issuances. So yes, it is potentially a cause for concern, but a market correction, if it starts a market correction, it can easily, it's actually a good thing for investors.
So would you think that you would not rule out another 5-10% correction from current levels?
Yeah, I don't think at these levels anyone can rule out 10% kind of correction. I'm not saying it's happening. All I'm saying is that it can happen. There's nothing that should not spark any nervousness for investors.
Okay. Sandeep, the other issue is the drivers from here on. So if you're an optimist, you'll say that the RBI is loosening. We have the income tax cut. And who knows, maybe we have some GST revisions as well, which make things more reachable for the average consumer. Do you expect a bigger pickup and a wider sort of a pickup in overall earnings? And is that already in the price now at 25,000? Or could that provide some cushion and maybe even some upside?
We are now exactly the way you framed your question. We are all looking at the margin. At the margin, is there a real upside, or at the margin, is there a real downside? I would think if you say anything of material nature, it should be about 10%. I would definitely, as I said in the beginning, there's going to be a slow grind up on the whole. I think we are not in a zone where we will see a major downfall of over 10%. So let's say between 15 to 20%. I'm not in that camp, but it will be a slow grind up. There are positive factors which are helping the market. The only negative I can see is the amount of supply and the quality of supply. Obviously, the quality of supply is always a concern, and it always, something which we know post facto. Once the supplies hit the market, once the first quarter numbers are out, that's when we realize that these were duds. So yeah, this is where we are. At the margin, positive, but need to be careful and would take any correction in market as an investment opportunity.
Okay. All right. Sandeep, I recall you joined us post Trump's first round of tariffs, and you said India will outperform. And kudos to that call, because India actually did pretty well and we bounced back very, very well. And one sector I think that you said is pretty well placed is pharma, if I remember correctly. Is that a sector that you're still bullish on? We
continue to like Sun Pharma. We think that's something which offers both earnings growth and in a very high valuation market, still decent valuations. So Sun Pharma is definitely what we like. I think we are now in definitely a stock pickers market. Or rather, I would say that we are in a stock pickers market for some time in the future too. As I said, I don't expect a major correction, so this is not going to be a screaming buy market. Therefore, you have to be extremely careful. Either look for earnings growth of 12%, steady earnings growth 12%, which you see can continue for, let's say, 2+ years, at least 3 to 5 years. Then you will be in the money in that stock, or you look at earnings surprises. I think one sector that we initiated and we liked has been the hotel sector. We have seen some negative headwinds come through because of the air accidents and because of the wars and because of travel. So again, this is a structurally bullish sector. We like companies such as Chalet or ITC Hotels. And so if there is a correction in some of these sectors or stocks, then that's something which investors should look at. As I said, look for steady earnings growth and price corrections in high quality companies. Those are good names to look at.
Absolutely. Sandeep, what you were saying earlier, right? 10% kind of fall, no one should panic. I don't think anyone, that's the problem. There is no panic. As good as there's no panic, but it's also a problem, right? Because everything gets bought into so fast, and before you know it, they're right back. They snap back so fast nowadays, right? So there's no sustained, or it doesn't stay low for very long. First of all, the dips are not very sharp, and then they don't last for very long. Actually, they last for very, very short times, and it's getting shorter and shorter. Is there a problem? You always got to have a list ready, right? And cash in hand to be able to take advantage of any of those opportunities.
I think that's a very sharp observation. That's for something which I also been talking to fund managers, that these pullbacks and this characteristic of the market that you are just described, that it's a short and sharp pullback, is actually something which has happened in the last 2+ years. It's never been like that before. When we got a correction, we got a healthy correction, as it was said, and it was quite a prolonged correction at times. But we are not in that zone now. And, I'll give you a perspective on this. We had the Macquarie strategist come in and meet investors just 2 weeks ago. He's Mr. Victor Schwetz. He comes regularly on your channel. So I'll tell you what when he was discussing India, what he said was India will emerge as a separate category within the emerging markets. So most fund managers, when you talk to them, they're based in Hong Kong, Singapore, Europe, or US, they look at a bunch of markets in the emerging market universe. So there's, of course, the big US market, then there's the European fund managers, and then there are emerging market fund managers. So the emerging market pack is where India resides. While India is part of the emerging market, actually what happens in the emerging market pack is that 2 countries, such as which are Taiwan and Korea, are developed. So they actually will eventually migrate out of the EM pack, emerging market pack. Now there's another big giant, China, which for all practical purposes, and even Macquarie's view is that it's in a structural kind of slowdown, and there's structural challenges of investing in China, which means that the only other large market that remains in the EM universe, in the emerging market universe, is India. And actually now he said that India will emerge as a separate category and a separate market within the EM universe. So like you have US specialist investors, you have, let's say, European investors, which is still a couple of countries which are in Europe. But India will actually emerge as a separate investing entity within EM, because most of the other EMs don't make much sense. Now, that's not going to happen in 2 years' time. This is a 5 to 10 year phenomena. But we are witnessing the migration of India and the separation of India from the entire emerging market pack over the next 5+ years. So this is probably one of the golden periods of investing in India.
Which basically means that you've got to pay a high price. You've got to be ready to pay a high price of admission, right? It's a good point, and we're most likely going to be speaking with... I read that note that Victor wrote, and we'll be speaking with them next week. So we'll bring up some of these things. But good explanation, good context, Sandeep. Thank you very much for joining us here on the channel. There's so much demand, right? So you got to have supply on the other side as well. So oftentimes we complain about all the supply, but supply is good. Otherwise, demand is going to overwhelm. And we're talking about some new supply which is coming to the market, a new IPO. So it'll be HDB Financial Services.
And it's been one that's been awaited for a long time. It's going to be the largest issue, perhaps, at least as far as this year is concerned. We haven't seen something as big. We're talking about 12,500 crores. The subscription is open today. The price band is between 700 to 740 rupees a piece. The proceeds of this issue will be utilized for future capital requirements. About 2,500 crores comes into the company, and then there is a OFS part of it as well. So let's understand HDB Financial Services better. We have with us G. Ramesh, Managing Director and CEO, as well as Jaikumar Shah, Chief Financial Officer at HDB Financial Services. Gentlemen, good morning and thank you so much for joining us. Welcome to the studios. This promises to be the start of perhaps many interactions in your due course of your listed independent financial market journey. So very interesting business, sirs, and I just want to put some context out there. A lot of your lending is happening in tier 3, tier 4 parts of the country. And for the benefit of our viewers, I just want to put this out there. We'll put some graphics as well, that the 3 key business verticals for HDB would be enterprise lending, which is almost 40% of their business. There's asset finance, which is another big piece. And then there is consumer finance. So just broad thoughts over there. You've managed to grow the AUM, if we go by past years, CAGR at roughly 20%. As you come to the market, what's the sense on the scale and size of the business, the growth, and the key drivers ahead for HDB? So,
thank you for inviting us today, and good morning to all the viewers. So we started the company in 2007, started lending in 2008. Today we have a balance sheet size of about 107,000 crores. It's an organically built balance sheet. We didn't do any acquisitions over the years. We have 19.2 million customers as we speak, presence in 1170 cities through 1771 branches. So that's the scale of our distribution. That's the scale of our business. And we've been growing through the last 17 years of our journey. What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. So our business and technology stack is independent of the bank. And we believe that, with a product suite that serves the needs of aspirational India, we are well poised for making the opportunities in the future.
Mr. Ramesh, I'm glad you're clarifying that point, that from a lending perspective, you're very different from the bank.
That's right.
But just clarify on this part, you do get, you do some services for HDFC Bank, right? The sale of services, as that part of it is called.
That's right.
I think FY24, it came down a little bit, the contribution from that segment, FY23 also. So just tell us what the thought is, because it's been giving you more than 1,000 crores of revenue every year.
Right.
So going forward, will that continue to be a big revenue stream? Are you looking to scale it down? What's the thought? The BPO part of the business for the bank.
Right. So we provide some BPO services to HDFC Bank and only to HDFC Bank. It's in the nature of collection services and some back office work that we do for the bank. That scale of that business really depends on the volume requirement of the bank. In the last few years, the bank has invested in digital capabilities, so some of the requirements have come down. While it's a significant part of our revenue, it's a very small part of our net revenues, which is our profit after tax. Given that our loan book itself is now 107,000 crores and generates significant revenues, it's a small portion of our net revenues in that sense. So not very material from a business perspective.
But it'll come down. That source of revenue eventually will be coming down.
Yes, relative to the lending business will come down, yes.
Let me just complete that point. Good morning, both of you. Thanks for coming down. So there are these RBI draft rules, right?
That's right.
With regards to overlapping business. How, as they are firmed up, what do you think is going to happen? I mean, what are the possibilities? How will you have to deal with it?
So essentially, the draft rules came out about 8 months back, right? Yeah. And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. I'll be back in your studio when the final.
Is it possible you may have to get rid of the business or merge it?
So those are scenarios we'll look at based on what the final circular says. As I said, we are run as an independent business. We don't see any, and the reason why we set up this business, independent business, is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending. Our top 20 customers account for less than 0.34%.
No, it's very, very granular.
Right? So that's the level of granularity of a business, and which is what I think is best serviced through an NBFC model.
Yeah,
that's
absolutely. And we'll talk about growth, and we'll talk about the real stuff in just a bit. I just wanted to get this point about HDFC Bank out of the way. It may also lead to HDFC, the bank, having to sell their stake down to 20%. If that were to happen and it's no longer the parent, I mean, then does it affect?
So it doesn't affect the business model of the company in any way?
Ratings, ability to access
so
funds?
I mean, again, it depends on scenarios of what happens, where does the ownership get transferred to, and things like that. So I said, you invited me to your studios again. We'll talk about it in the final circle.
I think you want to chip in as well.
As Ramesh quoted, RBI in its annual report has said that they will issue based on the feedback received. And I think that's an important point to know, that the regulator has taken in the feedback and it will work with us. Today, RBI is probably one of the finest regulators in the world, right? They've classified us as an upper layer NBFC, and as part of that, wanted us to list. So we'll work with our regulator to make sure, what's best for the company, what's best for the country. We'll go ahead from there.
Okay, all right. You all can't give us fixed numbers, but I just wanted to know about the way things are going to move ahead. The cost to income ratio is relatively high if you look at some of your peers. So how do you see that panning out in the time to come? And in the past year, maybe a couple of one-offs, but the credit cost spiked up a little bit. How is asset quality looking, and what's the way ahead?
So let me take that one first. So if you look at how Ramesh explained a bit about how retail we are. Now, when you're touching every single part of the country, right, and your average ticket size is approximately 1,65,000 and you're disbursing 4,000-5,000 crores a month, you can imagine how many touch points you have. If you were to give out a 5,000 crore loan, it's very different to giving out a 50,000 rupee loan. You still have to do your KYC, you still have to make sure your customer is good, you still have to make sure, you've understood the credit of the customer. That kind of retail granularity, right, demands the kind of cost that it does. The most important focus for us is the return that we generate at the end of the day. I think the way you look at different models, and you all analyze probably more than I can imagine, each model works differently, and this is a product that we've developed in a manner that services the real Bharat and at the same time delivers the right return for our shareholders.
So on that point of asset quality and what your shareholders can expect going ahead, I think about 30% of the book is unsecured right now, 70% is secured assets. Are you planning to maintain a similar ratio? Just give us some more sense on the unsecured part, because typically that's better for business, higher yields. So what's the thought process between secured, unsecured, the way you see yields moving as the book grows?
So we have a 73% secured and 27% unsecured as on March 31st, 2025. That's been in the range of 75, 25, 70, 30 over the last few years. Unsecured lending is a business that we've been doing since 2008. That's the first business we started. As I said, our focus has been that how do we touch our customers' lives as many times as possible through our products. So our product development strategy has been around making sure that whenever a customer has a credit need, do we have a suitable product that meets the customer's requirements? So it's a business that we've been doing now for 15 plus years, very comfortable with a 75, 25, 70, 30 range.
Okay.
Yeah.
In terms of growth, I mean, there is, it's a long, highway of growth, and most lending institutions, and you're well diversified, you've got the name, you've got the branding, you've been doing this for a long time. Could you give us some sense of how growth will look? Large numbers, since we can't be specific, let's go long. We can't talk short.
So, so let's look at a few fundamental things. Right?
As you said, you're about 1 lakh plus or crore
right.
size.
Yeah. All organically built, yes.
Yeah. So say in the next 3 years, where will that number be? I'm talking about,
Right. Okay. So I can't give you a forward-looking guidance, but what I can tell you is aspirations.
You can't give me forward-looking, so maybe really forward-looking. That's my roundabout. But
One is that you look at our distribution, 1170 cities. You can imagine what the 1170th city actually looks like, right, in India. 70% of branches in city number 101 and beyond.
Yeah.
Right? A phygital distribution model, and one of the things Jay was referring to when we said our cost to income appears slightly high, but that's also because we're looking at the customer and saying, what is the best option for this customer to engage with us? So we don't say you can only do digitally or you can do physically. You're saying choose the method that you want. You can do a purely physical or purely digital. We are comfortable with either. Our response times on processing applications are no different, whether a customer comes into the physical model or digital model. The fact that the back end is fully digital, 97% of applications have a digital footprint, right, in the form of processing. And one of the propositions we offer to our manufacturer partners, and we work with more than 100 of them between our consumer finance and our commercial vehicle and construction equipment business, is that irrespective of where you are in the country, our response time will be the same. So whether it's a metro like Mumbai or whether it's a small town somewhere in Assam, our response time is the same. Our customer growth has been about 29% in the last 3 years. Our AUM growth has been about 20% last year. And we continue to think about what new products we can add to the suite we already have. And that's the way we think of growth.
Just a quick last point. Again, I know you can't give very specific answers, but we need to understand an assessment on the borrowing mix, the yield, the margin profile that aspirationally you think you can sustain and maintain. I think first half it's been around 7.6%, Jaikumar. In the past, on a full year basis, you've maintained margins upwards, northwards of 8% as well. We're in a rate cut environment. So what's the sensitivity to margins in a downward rate regime? Just give us some color. Is 8% sustainable, long-term basis?
I'll give you two components to it. One is our yields and second is the borrowing cost.
Yeah.
And we have a very matched principle in terms of how we borrow. So we don't borrow short and lend long. We don't borrow too long and lend short, either ways. So we have a 3.5-year book approximately, and we borrow 3.5 years. Now, on that, one important component is, if you look at rates that were there in 2021-22, it had gone down to as low as 5.7 and 6. And the rates that came out in 2024-25 were approximately 8%. So one of the things which happened is a spike of around 200 bips, which just shot up very fast. Now, for a retail business like ours, when you're going to a customer, neither does it go up very fast, nor does it go down very fast. So that's a bit of spike which has come through. As the balance comes back, I think things will fall in place.
Which means higher margins eventually as we go down the cycle.
So the way I would look at it is, what was I borrowing at maybe in January to now? The rates have purely cooled off by almost 50 bips. That's just a statement in the market. And with our parentage, with how we operate as a company today, we are probably the finest borrowers in the market. And that's just public data. 37% of our loans come from bank borrowings, and more than 45% almost comes from NCDs. We're the largest issuers of debt today in the 2 to 3 year space in the country. Okay. So we don't talk about it as much, but we're very happy that, we can work behind the scenes. Our treasury is completely independent of the bank. We operate on our own and make sure we fund our own assets.
Are your most of your loans, are they fully linked, external benchmark linked? How frequent is the reset? I'm just trying to understand how quickly you have to revise them lower.
So in terms of our loan book, only our LAP book, which is around 23% of our overall book, is floating. Okay. The remaining entire 75-76% is completely fixed rate.
All right. We'll talk numbers and guidance next time you're on, and after that as well. Thank you both for joining us.
Thank you. And
thank you so much. Pleasure.
Good luck.
And during that conversation, we already fixed the next couple of interviews. So looking forward to having you back in the studio. Thanks a lot.
So much. Thank you for inviting us today. Thank you.
Well, let's get to the next management then. That of REC. Mr. Harsh Baweja, the Director of Finance at REC, joins us to talk about the impact of RBI's new project financing norms, rate cuts, as well as the outlook for the remainder of this fiscal. Hi, Mr. Baweja. Thanks a lot for joining in. Well, it was definitely a relief that came in from the RBI when we looked at project financing norms. Help us out now. Help us decode some of these final guidelines. How do you read this? And more importantly, how will it impact your business as well as your capital ratios?
As far as REC is concerned, since this is not coming retrospectively, this will be prospectively. So ultimately, the book up to 30th September 2025 would be governed with the existing rules, and this will be applicable to the financial closures to be done after 30th September 2025. So it will have a very insignificant effect on the balance sheet of the company. Reason being that as of now, my provision on the standard assets is already 0.94%, whereas the RBI has mandated the minimum 1% provision for the under construction project. So we don't think that this is going to impact our balance sheet. Number two, NBFC's accounts are basically governed by the India system, and whatever additional provision, if there is on account of RBI provisioning are there, that is routed through the impairment reserve account. That doesn't affect our PAT basically. Number two, the guidelines says that total provision of 1% on the under construction assets is to be made. So in case if I do the financial closure of any of the asset in the Q3, then the provision will have to be made progressively based on the disbursement to be made in the quarters to come. So it is going to make any effect, very insignificant effect in the books of accounts, and that will be done only progressively. And simultaneously, I can say once that asset achieves the completion, then the extra provisioning made will be reversed to 0.4%. So ultimately, this will be a continuous business after the March without affecting my previous business, which has already been done.
Okay, got that, sir. Now, your company reports low credit costs, right? But as a key market player, do the final guidelines also indicate that RBI does not see increasing risk in project financing? And can we expect that for your business as well?
As far as my credit costs are concerned, that is already at a very low rate, and we make a provision of 0.4% of my stage 1 assets and 0.5% of the stage 2 assets. For under construction project, as I have already explained you, for the new projects, we will have to make an extra provision. But having said that, if you see my numbers of the 31st March 2025, I am already at the level of 0.95% of my provisioning in the standard assets, stage 1 assets. So perhaps we don't see much of the impact on the ECL numbers and the credit costs in the near future, sir.
Okay. Mr. Baveja, another tailwind perhaps is, of course, the rate cuts. We're in a downward rate regime. So how will this impact your spreads? Any internal assessment that you have done for the business? Maybe if you can give us some sense of margins.
As far as the RBI's rate cuts are concerned, we have yet to see the impact coming to the market. Since if you see the bond yield, which has been happening for the last 2 or 3 weeks, even post the rate cuts, there is not much of the rate cuts in the bond yields that is coming in the market. Rather, before the rate cuts, REC could raise one of the cheapest source of funding through the institutional bonds. But in the recent times, say within last week or so, the bond yields have gone high. So we have yet to see the impact of that and the impact of the CRR, which is to be done in progressive manner. But yes, some insignificant effect in my cost of borrowing will always be there, since whatever fresh borrowing is coming, that will be coming at the reduced rate. And we think that our guidance regarding the NIM, we have given a guidance of around 3.5% to 3.75% and a spread of around 2.75% to 3%. We hopefully see that we would be able to maintain this range within this range, and we'll monitor it quarter by quarter. We see that impact further coming up in the market.
All right, so let's get back to the guidance then that you've given. I think around 12% loan growth. Last year, the numbers impacted because of higher repayments. How much of repayments do you expect this year, and what kind of loan growth should we be factoring in?
Since we are into an NBFC business, we will have to understand that prepayments are the part and parcel of the total business profile. You cannot ignore the prepayments. Number two, in case if any of the agencies is making prepayment to us, it means those agencies are the sound parties, sound clients. And if my clients and my loan books pertains to the agencies, those over the sound books, sound agencies, that in that case, I can say that my balance sheet is also very strong. So prepayments will keep on coming. We are not afraid of that. We treat it as a part of the regular business activities. But yes, we expect that our AUM will grow at the rate of around plus minus 12%. And quarter on quarter, we'll see the progress, what is happening, what is the percentage of prepayments are coming up. Since one of our product, that is revolving bill credit facility, that in itself has the characteristics that agencies, whenever they have the surplus, they can make the prepayment even without the prepayment charges. So that prepayment will keep on coming and that will affect our loan book also. But keeping that aside, rest are the very insignificant amount. Some of the amount had been made by the prepayment by one of the borrower who had raised the fund through their IPO proceed. Similarly, one of the big borrower had made the payment to make their headroom available for their new sanctions, then they had reached the exposure level. So these type of cases will continue to happen. And we expect, despite all these things, that we should be able to maintain plus minus 12% growth.
Okay, all right, got that. Mr. Viveja, finally, we are in Q1. What should investors expect from REC as this year rolls on? Any sense of how so far business has shaped up in this quarter, growth trends, yields, anything you can leave us with?
Quarter end is not very far off. Let us wait for the quarter end to be completed. We are working very hard on all the aspects. We are focusing on improving our quality of the books of accounts and quality of the assets. We expect that by the year FY26, we will be a zero NPA company, and some of the assets are at the advanced stage of resolutions. Disbursements are absolutely on the same track. In case if the prepayment doesn't happen, that it should be on the same target as we expected earlier. And as of now, for this quarter, we don't expect any effect on the NIM and the spread. That may be continuously on the guidance. And we say that since we are in the financing business, we should keep on reviewing every quarter. What is the impact? The things are changing very fast. So market is moving very fast. 15 days before, the yield rate was different. Yesterday, the yield rate was, bond yield rate was different. I am raising fund from the market. Even the international market is different. We have raised from the ECB markets. The rates which were available at the end of the March are very much different, the rate prevailing as of now. So we have to review it and we have to focus on each and every day and each and every quarter, and we'll keep on reviewing. But yes, as far as the borrowings are concerned, on the date of requirement, we don't want to keep any funds idle. But yes, on the date of requirement of the fund, which source is cheaper to us, we go for that kind of funding so as to arrive at the good cost of borrowing.
Well, thanks a lot, sir, for joining in and giving us a sense about the impact of RBI's changes, as well as some sense about business. But we look forward to chatting up with you at the end of the first quarter numbers and get a further sense about the year ahead. For the time being, we'll slip into a short break. On the other side, we'll get an exclusive chat going with Mr. Mohanty of the Indian Rare Earths Limited, as the government is expected to finalize a rare earth magnet manufacturing scheme soon. Stay tuned for that conversation.
Okay, welcome back. 140 points, 25,180 is where the Nifty is trading at. Now, the government is expected to finalize a rare earth magnet manufacturing scheme within the next 10 to 15 days. This comes after China curbed the export of these magnets, which are critical for electric vehicle manufacturing. Sources say that the new initiative will have an outlay of 1,000 crore rupees and support capacity of 1,500 tons of rare earth magnets. The secretary at the Heavy Industries Ministry, Kamran Rizvi, has said India is in talks to import rare earth minerals from Japan and Vietnam.
Are we looking at any other countries where we can source the item except China?
So you are aware that rare earth is available in Japan, in Vietnam, and efforts are going on to bring from there.
So now we have someone who really knows the lay of the land as far as rare earths are concerned. Mr. S.B. Mohanty is CMD in charge and Director of Finance at IREL. Mr. Mohanty, good morning. Thank you very much for joining us today. Important that we are having this conversation to get a real sense of where we stand. So as you heard, the government, of course, is wanting to set up that processing capacity here, plans to import some of this as well as we are facing curbs from China. Give us a sense of state of play here in India with regards to these rare earths. And the rare earths I'm talking about are specifically, 4 or 5 which go into these magnets. So I hope I'm pronouncing these correctly. Neodymium, there is dysprosium, there is terbium, etc., etc. I mean, these 4 or 5 of these rare earths which go into these magnets, which are important for the auto industry, EVs, etc. Do we have sort of enough reserves of this here in India? Do we have the processing capacity? Could you give us a sense?
Yeah. Good morning, and thank you very much for calling me to this program. Actually, the India is having heavy mineral of 1,300 million ton of capacity, and out of that, monazite will be around 0.1%. That is 13.115 million, and rare earth will be 6.9 million ton we are having. So, but as per the content of the material, so we are having heavily this lighter rare earth elements, and this heavier part is not available in our resource, which is found only in minuscule or in the ppm level. So that is the key issue. Otherwise, if this magnet making is, we'll look into the magnet making, there ND, PR, and this DYTV. This NdPr is neodymium and praseodymium. These 2 elements are used. And at our capacity, we are having Nd oxide, and up to oxide level we have been making it. And we have got sufficient quantity as of now. Because earlier 2020, we have tried to see what is the market absorption of this material. And that time we have made one expression of interest. But during that, very few parties came up, and ultimately all of them backed out because of this inverted pricing mechanism. So how it has happened is there are 2 aspects. One is our this feed material for NdPr is costlier than the NdPr, and at the same NdPr oxide, and at the same time this this NdPr oxide price is higher than the metal as well as this alloys. So on that basis, the economy of scale is not properly made, so that people can come and invest in this area. If you look into our particularly the how India is poised for the heavy rare earth elements, we have to get it either imported or we have to look for the resources like from the hard rock minerals, which is available in India, but that will take little bit of time.
Yeah. Mr. Mohanty, so just to clarify, you're saying that, and you need heavier and the lighter elements to essentially make these magnets, right?
Right.
And the heavier we don't have, so we have to import them. That's what you're telling us.
Yes.
Okay, got it. I just had a basic question. processing of rare earth and getting them out, I mean, it's seen to be, as far as I have understood, extremely environmentally damaging as well. And there is very little one can do to mitigate that damage. And that is why many countries around the world have not developed these industries, and they sort of have relied on China all these years. Is that a correct assessment? And what is our plan? I mean, there is, of course, getting it out of the ground. The other is processing it. So just your thoughts on both.
Actually, yes, that is correct. Partially correct. Actually, there are two different technologies are available for making it. One is calciothermic reduction process, and which is not environmental friendly. At the same time, this molten salt electrolysis process, if that is more environmental friendly. So if you look into those things, people, the countries started, China, they sent the material to China and China processed it because of this environmental rules and regulation. Initially, China was having around 200 different companies operating in their country. And at that time, it was processed, and the environmental laws, regulations are not followed, particularly there. Cheaper manpower, all this source was happening there. And by that way, the prices, whatever is coming for this product, the cost of production of these materials are at a cheaper price they are making it. And yes, of course, the environmental footprint is definitely there. In our country particularly, we are looking for this molten salt electrolysis process, which is some of the magnet manufacturing who have shown the interest, they are having this facility developed already.
Mr. Mohanty, so I'm trying to simplify it further for our viewers. You know, when this crisis unfolded upon the whole world, including us, and most of the auto companies are saying that they have these magnets, maybe a supply for about 2-3 months. After that, it could be problematic. So now we're talking about this Atmanirbhar scheme, right? To even try and get self-reliant in these rare earth magnets. So just simplify this for us. You're saying the heavier type of earths, they're not found in India. So that's a separate issue. So to what extent can we look at manufacturing these magnets in-house? There is first the question of whether we have the required type of rare earths. Then is the question of whether we can set up the refining capacity, and I'm sure that's not going to come up overnight. So realistically, what are we talking about in terms of Atmanirbharta when it comes to these magnets?
Okay, so what happens in our process? We are getting this feed material for this rare earth is monazite. And this process is entirely cumbersome and complex. And this rare earth element, what we are getting is not of economy of scale. So on this process, and this rare earth elements are radioactive also, because monazite is a radioactive element. That further make it complex. So the process is also difficult. And as a result, what is happening? We focus on our lighter rare earth, particularly NdPr. There is no issue. We have developed the capacity. Right now, 11,000 ton of REO we can produce. So with that, we can have around, we have got capacity of around 800 metric ton of NdPr. So from there, around 2,400 ton of magnets can be made. But because the feed material is not available, because you know the challenges we are facing, particularly the sourcing of this monazite processing.
So, sir, just to understand, because please pardon us, these are very, very technical processes in terms. So we're trying to simplify this for our viewers.
Yes.
You just said that 400 tons of magnets can be made. So are you saying that with the available, reserves that we have, we can manufacture 400 tons of these rare earth magnets in India as of now?
No, I've said NdPr oxide is the feed material for making of the magnet. So NdPr oxide we are making. From the oxide you have to make the metal, and thereafter the alloys, and this magnet will come up. So now currently we are having NdPr oxide, we are producing around 400 ton. So but we have got a capacity of around 800 ton. So we can cater, if full capacity we operate and we get the entire monazite for processing, then we can go up to 800 ton, and 800 ton can cater to requirement of around 2,400 ton of magnets.
Got it. So we're working at 50% of the current available capacity of this, pretty important material, which is the NdPr oxide.
Just one more point, sir. The ratio is 1:3 then. 800 tons can produce 2,400 tons, correct?
Three times.
Three times.
That's the rough conversion ratio. Yeah.
Okay, got it. So, yeah, that helps us understand some of the basic brass tacks. Now, sir, the scheme apparently is going to have an outlay of 1,000 crores. So the government wants to make India as self-reliant as we can be. What should be the ask? And private industry wants to chip in. I mean, we've heard from a lot of, metal companies. Nigel's been telling us about, for instance, the Vedanta Group has been talking about it. What are the first steps? Where should the money be put? Refining capacity will take how long? How can we become more self-reliant? What would your recipe be? Whether it's mining of the rare earth, processing, and ultimately making those magnets?
Right now, what we have to do is we have whatever the NdPr oxide we are having right now. Let's have this facility for the magnet making, so that we have to go stepwise. First step will be whatever NdPr oxide we are having, we should be in a position to convert it into the magnet. So before going for magnet, we have to convert it to metal to alloys. These technologies are heavily guarded, and right now the technologies are not available in an economic scale. BARC and DMRL, they have got the technology, and we have to upscale it. So that is one aspect. So when we are looking for what is to be done right now is one aspect is we have to ramp up our the production capacity right now. That to make it the nameplate capacity we should achieve first. So thereafter we have to look for the demand. So demand 2030 it will be coming around 8,000 ton of magnets roughly as of date it is spoken, but it is very difficult to predict the exact requirement of the magnet in the country, because magnet is as such magnet is not getting imported to the country. It is embedded to the product, and product is coming to country, and the product HSN code whatever is there, that is different. So we are not in a position to predict exactly how much quantity of magnet is required. So as such, what we have to look for is instead of monazite, we have to look for this ionic clay where the process is small. So quickly we can come to this rare earth chloride stage, and from there we can quickly go for NdPr oxide, and thereafter this making of metal and alloys. So by that way we have to proceed. Initially we have to look for this import of other source of this rare earth elements. That is one, and utilize our fullest capacity. And where our another one is this circular economy, where this end of life magnets, where we are utilizing right now only 1%, and we have got a potential of around 20% we can utilize it. Where you can see in China it is 100% they are recycling. So in some cases of lithium batteries, which was earlier 5%, they have gone up to 95% recovery. So in this front, if we will be in a position to recover better, so that will also solve a lot of issues in our case.
Okay, all right, Mr. Mohanty, you're giving us a good science class this morning, and we request you to come back on the channel, because we can have a longer discussion on this front. But very quickly, because the markets are live as well, and the markets would like to understand what is the private participation. So have you heard about any private participation from the likes of Vedanta, as Surbhi has mentioned? And is there any role that's chalked out for a company like GMDC? Because there is hope. The management out there has been saying that they're looking at this part of the business. So have you heard anything on both these two companies?
So initially GMDC, yes, they are going ahead with this. They are looking for hard rock mining, and definitely they are coming up with the complexes coming up there. And we are also looking for this hard rock mining in Rajasthan, Sivanaring as well as Kanthai, where this hard rock mineral is available, and that contains heavier rare earth also. So quicker we go for that, that will be better for us. And similarly, you are talking about other like Vedanta. Yes, Vedanta, we have not heard they are coming up for this magnet making. But other private players are there who are showing their interest. 5-6 of them are there. And we hope the things will change soon.
You could name a few, sir, of the private players?
Like Intellus is one, and other one is Midwest. And
okay. These are all Indian companies, private companies.
Indian companies, yes.
Okay. Got that. Very, very interesting conversation and a lot of science, as Nigel said. I'll have to go and revise my periodic table. Do you guys remember the periodic table?
Oh, God, 108 elements. Don't ask me to name all of them.
Hydrogen, helium. I think
It's all tongue twisters.
But Mr. Mohanty, you did say feedstock, right? That we don't have the feedstock. What is that feedstock?
Actually, I will let you know. 6.9 million ton of this rare earth elements are there. But the challenge is how to access it. So although the minerals are there, then you should have the surface right also. Because actually all these are available in the placer deposits where this habitation is full of habitation. So getting the access to the land is very difficult. And there is a misnomer going on, and some illegal miners they spread this news that it spread cancer and all. But actually, what happens in reality is when the monazite, which is the radioactive element, it is taken out from the pit material, so it became background radiation reduces. So on that front, it is rather more beneficial.
Yeah.
So those things, misnomers are not there. And on top of that, if I will compare, this Chinese source is 6%. They contain 6% of rare earths. And in India, we are having 0.056%. So they are superior in 100%.
Yeah, absolutely.
That way,
And so,
to get only 800 tons, that is the nameplate capacity, 800 ton of NDPR, we have to handle around 10 million ton of raw sand. So you can this volume.
Wow. Very, very fascinating stuff, sir. Thank you very much for running us through all of that. And maybe you can come back as we continue the progress on this front in terms of setting up this industry, actually, the entire value chain. And there are so many elements, as you said, have to go step by step. But really appreciate you sort of clarifying a lot of things, much better understanding, and I hope useful for the viewers as well. Thank you.
Thank you.
Okay, all right. We got 130 points on the Nifty, 25,180 at this point. We take a quick commercial break here. We'll focus on commodities as well. Manisha back with us in just a bit from now. There are some flashes, interesting stuff coming in from Mr. Mukesh Ambani, Chairman Reliance Industries, in an interview to McKinsey. And we'll take note of that as well in just a bit from now on the other side. Stay tuned.
Welcome back. The markets in fine form, 134 points up on the Nifty. Mid-caps are also in cruise control mode. Let's now turn our attention back to the commodity markets and see what's the latest. Manisha has not been able to take her eye off crude at all last, I think, couple of days. I wonder if it's still crude or something else, Manisha, now this time.
Oh, well, you know, with crude just about holding 1.5%, decided to move on to some other commodities as well. While crude, of course, stays in headlines there. But you have to look at the kind of gains that we've seen come in for the copper prices. Well, that is trading at a 2-week highs and has shown a quarter resilience, actually, with all that has been happening in the global markets, whether it has been about tariffs or about geopolitics as well. The currency is moving all over the place. China data not coming well, but we have seen copper prices show that resilience. Well, the reason that you have seen gains also come in the overnight market is the Iran-Israel ceasefire. It also has been about dollar index slipping back below that 99 level has been supportive as well. And then when you look at the markets right now, it clearly is a huge arbitrage that you are looking at in the space. Copper prices are trading in a backwardation one. When you look at the cash versus the 3 months, that is how it trades on LME. The cash is at a $345 a ton of a premium to what the 3-month futures are. And this is the kind of situation that you have until June 2026. So the near-term demand for copper definitely seems quite supportive there. Also, when you look at the ready available copper inventories on LME, they're down by 80% in 2025 so far. Actually, when you look at the inventories from March onwards, the last 4 months have seen inventories decline by 65%. This is the lowest kind of inventories that you have seen on LME in almost since 2023 August, perhaps. Interestingly, with the kind of LME inventories that we have right now is less than 1 day's global consumption. So that is what clearly seems to be adding premium to prices there. Interestingly, when you also look at the refined copper shipments, well, to US have been at a 200,000 tons, which is the highest in a decade, is what we've seen in this year until now. While the traders are reacting to the rapidly falling inventories, potential US tariffs, it also has been about pricing crisis at smelters. And that really should come to your notice because excess capacity, insufficient raw material has taken the prices on the higher side. So much so that the spot treatment charges right now stand at $45 a ton. When you look at the copper prices, it has been steady, as I said, resilient even. For the week, we are up by a percentage point, up 2% for the month of June. And in this year, outperforming the other metals with 23% of gains.
Okay, all right. Manisha, thank you very much for that. So that's essentially the commodities picture. Let's talk about some individual names now. Torrent Power, the stock should come up on your screen. Vivek is standing by with what's going on here. I think sharp bump up and then a bit of a drift is what we are seeing. Vivek, take us through it.
Well, that's right. So Torrent Power is in focus. This is an important as well as a material development as far as power distribution companies as well as, power distribution itself in India is concerned. MERC, which is Maharashtra Electricity Regulatory Commission, on a public notice on June 23rd, has expressed satisfaction that Torrent Power can go ahead and offer parallel DISCOM services in 3 key areas, which is Pune, Nagpur, as well as MMR. So now the company can actually act as a parallel DISCOM service provider or as a parallel power provider to simplify it. Now, what MERC has said is that they express satisfaction for the company. This will act as a parallel electricity distributor. And interestingly, Torrent Power's offer as far as, this particular service or offering of service for power is actually at a slight discount to what the current prevailing rates are. Now, remember, company had actually gone ahead and petitioned to act as a distributing company in December 2022, and it was under evaluation for the past 2.5 years. Why is it important as far as Torrent Power is concerned? The company had projected a capex of close to 15,000 crore on which it could get an ROE of close to 15.5%. What is the capex towards? Capex is for 5 years towards transformers, distribution lines, substations, as well as related assets. Now, importantly, MERC will hear the final petition filed by Torrent Power on July 22nd, and which is when we will get to know the final outcome, whether they can go ahead and act as an alternative or as a parallel distribution provider. JM Financial today, in a note to its clients, has mentioned that this particular development is value accretive and can open a new stream of opportunity in future. It's an important development, number one, for Torrent Power and also for the power DISCOM space, given the fact that this could act as a precursor to going ahead and seeing more players as far as power service provision is concerned in the DISCOM space.
Okay, all right, Vivek, got it. Thank you very much for that. We will have to take a quick break on that note. Come back on the other side. We'll have Vishruth Rana of S&P Global to discuss growth and inflation outlook amidst geopolitical volatility. Welcome back. So we're talking macros now. S&P Global has increased India's FY26 GDP forecast to 6.5%. Their earlier estimate for the country was 6.3%. They're also expecting significant growth uptick in China, despite all the tariff conundrums. Vishruth Rana, economist Asia Pacific at S&P Global Ratings, is with us now. Vishruth, thank you so much for joining us on the show this morning. So we caught that note, quite interesting, because it's not just India, but you see more growth ahead in China as well. Just explain the thesis, because we still haven't seen the final word and the ink dry on the actual tariff. What is it that you're baking in your estimates when you increase GDP estimates for both India and China?
Yeah, thank you so much for having me on the program. It's always a pleasure. And indeed, in these volatile times, I think a forecast is always going to come with a wider band of uncertainty as the economic environment remains highly uncertain. But as you pointed out, one key swing factor turns out to be the tariffs and what we assume going forward for the trade environment. We currently believe that the Liberation Day tariffs that happened in the early part of May are unlikely to happen again, in the sense that we expect that the current 10% baseline tariffs that the US has in place are going to remain through the forecast horizon. In our assumptions, we assume that the US effective tariff rate will be at 15%, which is roughly the current level through our horizon. So that is one of the big drivers behind our upward revision in the region compared to our May forecast, when trade was highly more volatile and looking much darker at that time.
So what does this mean for, let's talk China, because when we're talking tariffs, obviously they stand to get impacted more. So you're saying effective final tariff for US at 15%. What about the tariffs on China? Because from 145%, then there was significant climb down. And exactly what are you expecting? A bigger uptick in China? What will drive it?
Yeah. No, that's a great question. So the 15% effective was on the global, from the US to the global.
From the US side, yeah.
Right. But for China, the level is closer to 40% in our estimate. So we estimate the US effective tariffs on China are roughly 40%, which is very steep. There is some diversion going on, in the sense that Chinese exports are going to elsewhere, to Southeast Asia, to Europe, before going onward to the United States. So part of that is happening. But of course, the bilateral trade between the two has climbed down quite sharply. But what does all of that mean for the Chinese economy overall? One, it means that there is a more adverse external environment, and that is baked into our forecast, which is one reason why we don't think that growth will hit the 5% target that China has in place at the moment. On the other hand, the more important part for China this year is how the domestic story plays out. So there, the property sector currently still looking a little bit adverse there in China at the moment. Consumer sentiment relatively cautious, despite some stimulus measures. Overall, the domestic economy is holding up a bit better than the external environment, which is leading us to revise our forecast higher, but still well short of the 5% target that the government has in place.
Okay, so now let's talk about India. The small increase in the forecast here, 6.5%. So what made you do that? Does it have to do with the easier monetary stance of the RBI? Your thoughts?
So definitely, I think one element to the forecast is this front loading of rate cuts that the central bank has engaged in. And we think that it will lift consumer sentiment, it should lift credit growth in the economy as well, which has been slowing for several months. On the other hand, the RBI did move to a neutral stance, which means that there's limited further room for cuts over the horizon. We think about 25 basis points of further cuts coming up this fiscal. Overall, the growth environment for the domestic side of the economy has held up slightly better, which is the main factor driving up our forecast for the year. In terms of the trade and tariff environment, I think India, one sheltering part for the economy is that it is more services oriented, both in terms of trade as well as domestic activity. And the service sectors have so far largely been exempt from the tariffs and trade tensions, which is going to be a positive factor this year.
Okay. Vishruth, otherwise, I mean, how do you size up the overall macros here in India? Growth, you're saying 6.5%. The hope is that inflation will remain under control. I mean, the last print was below 3%. And now with the oil prices again stabilizing, how do you see the next couple of months play out here?
Yeah, there's a couple of key factors, I think, on the inflation outlook. The first thing is food prices, of course, which is the key for India. And with the Met Department forecasting above normal monsoons, that should bode well for agricultural produce, and that means food prices should be relatively contained through the rest of the year. Indeed, we think that inflation is likely to come in just at the 4% mark for this fiscal year. Helped by the lower food prices, the outlook for energy prices is key. In India, of course, the producers bear some of the costs of that energy price volatility. Some of that is smooth before going to consumers. However, we think that energy prices for now are likely to remain range-bound, despite the recent increase in geopolitical uncertainty. And this means that energy price inflation should be relatively capped. I think one key swing factor to point out is the core prices and the prices of gold, which are currently playing into the inflation outlook. But for now, this remains relatively contained. We're not overly concerned.
Okay. All right, Vishruth, we will leave it on that note then for today. Thank you very much for joining in. Appreciate you taking out the time. With that, we're going to wind down on this edition of Bazaar. We're leaving the markets in steady form, 160 points up on the Nifty. The Nifty is actually doing better than the mid-cap index right now. Bank Nifty for the time being, also notching up gains of a little over 0.25%. So steady start to the day. We'll take your leave on this note, but do stay tuned. All the action continues. Up next is Chartbusters.